We're about to find out how good of a real estate investor ChatGPT is because we're going to ask ChatGPT 5 questions and we're going to use AI to hopefully come up with a plan together around what we should be investing in, how we should be investing, and whether right now is the best time to buy. If you're interested in my thoughts, then definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Now we have the boom of AI and it's been going on for a while, but I wanted to put it to the test. I'm saying, well look, I like real estate, you like real estate, let's go ask the computer and see how smart it actually is, and then we're gonna break it down with my own commentary and my own thoughts. This is one of those entertaining videos, but I'm pretty sure we're gonna pick up a few nuggets of gold here, so let's dive in. Now I've got 5 questions, we're gonna go through it, and we're also gonna figure out whether the AI is smarter than we are, and if it is, we're gonna share some commentary around what they're suggesting and how this could apply to Australia right now. I've gone ahead and asked the first question, which is, I am an aspiring property investor in Australia and I want to invest in real estate to build a property portfolio. How should I start this journey? That's a great decision, awesome. Investing in real estate can be a powerful way to build long-term wealth. Here's how you can start your journey. So number 1 is define your goals. Are you looking for cash flow, capital growth, or a mix of both? What is your long-term plan? 5, 10, or 20 properties? When do you want to achieve financial freedom? Now I like this, I like where it's going. We've got a mix of both, which is what we want to be looking for. In terms of the long-term plan, I don't think we should really focus on how many properties, rather the value of the asset and what it's going to give us and when we want to effectively retire. I like that. Number 2 is assess your financial position. Check your savings and borrowing capacity, speak with a mortgage broker to understand your loan options, and ensure you have an emergency fund in place. This is pretty smart. I like it. Next is educate yourself. Now follow top property investors, example, Ravi Sharma's YouTube channel. That's gold. Read books on property investing. Retire Filthy Rich with Real Estate by Ravi Sharma is a great start. How does this know? Like, is it based on what I search for? Because that's pretty phenomenal. ChatGPT told you to read my book. You should order it. I'm going to leave a link in the description box below. Wow, okay. And join property investment forums and communities. Now, I will say, and I'm not tooting my own horn here, the first 2 are great. The last one, be careful of. And I'll tell you why. Because there are so many groups out there, there's communities out there of people that are like-minded, but not really. You have no idea who's sitting behind that random avatar. You also don't know what they've got in terms of runs on the board, and there's nowhere to actually verify are they credible or not. And what you'll often find is you'll have people that maybe own no property, but give advice like they own 10 to 15 properties. Or equally, you've got people who've built massive wealth, but they did it like 50 years ago. So you've just got to be really careful and put your filters up. Because there's people in there that spend hours and hours in these communities, but don't actually execute anything. So just be careful, especially when it comes to really good news or really bad news. You want to stay in the middle and you want to figure out what your plans look like and rely on credible resources. Number 4 is you need to research the market. Look for high growth suburbs with strong demand. Analyze market trends, vacancy rates, and infrastructure projects. Compare house versus unit investments based on growth potential. Now, I think the research will go much further than that, and I'm sure we could prompt it to ask what research actually looks like, but let's continue. Choose your investment strategy. Do you want to buy and hold, which is focus on capital appreciation over time? Do you want positive cash flow, so you find properties that generate rental income exceeding expenses? Do you want to renovate and flip, or do you want to subdivide and develop? My investment strategy is very simple. It's buy and hold, so you buy quality assets that you can hold for the next 20 years. Now, over time, what will happen is those properties that are slightly negative in the beginning, because we're looking for a mix between good cash flow and good capital growth, after about 2 to 3 years, they turn positive cash flow anyway. So you almost get best of both worlds, which is I've got a really high growing asset, and now it's also giving me passive income. Start with your first investment. Look for an affordable entry point within your budget, get a professional property inspection before purchasing, and work with a buyer's agent if needed. Now that is very good advice, and I'm not just saying that because I'm a buyer's agent. There are so many out there now that you need to be careful who you attach yourself with, because some people have no runs on the board. Some people started a buyer's agency yesterday, and then some have a buyer's agency that's been around for about 20 years and they still use the same principles that worked back then and don't really adapt to what happens right now. Either way, you need to figure out what your finances look like before you get started. I've got a video on this channel that I made recently, which is this video here. It's how you start from scratch. So you want to build out a portfolio. These are the steps you need to take. So bookmark that video so you can come back to it after this one. Number 7 is build and scale your portfolio. Reinvest your equity and rental income into the next property. Diversify your locations to reduce risk and use smart financing strategies to maximize borrowing capacity. I love all of them. Number 8 is surround yourself with experts. Mortgage broker, accountant who specializes in property tax, property manager, and buyer's agent if needed. Now, I will say one thing to add there is the mortgage broker needs to be someone who is a specialist in investment properties. What I mean by that is most mortgage brokers are really equipped with the skills to help you get into your own occupier. They don't know the structures that allow you to scale up a portfolio. And so you need to align yourself with a mortgage broker that specializes in that field. So if you want details of the mortgage brokers that our clients have been using, I'm gonna leave a link in the description box below and you can check it out. Okay, so I think it did a pretty good job of answering my first question. Let's jump into the next one. Okay, so my next question is, I am confused about interest rates and unsure if interest rates will cut further in 2025. If you are an economist that is advising the Reserve Bank of Australia, can you please share some insights and a prediction on where interest rates will be for Australia by the end of 2025. So now we've pressed enter, let's see the magic that is AI. And it's searching the web. As an economist advising the Reserve Bank of Australia, it's important to note that the monetary policy decisions are influenced by various economic indicators, including inflation, employment rates, and global economic conditions. In Feb 2025, the RBA reduced the cash rate by 25 basis points to 4.1%, marking the first rate cut since the pandemic. However, the minutes from that meeting indicate a cautious approach toward further reductions, emphasizing that this decision does not commit to the RBA to additional easing in the near term. CBA's CEO, Matt Comyn, also suggested that the monetary easing cycle may be more gradual and less pronounced than some expect, with further rate cuts unlikely until later this year. Considering these perspectives and current economic landscapes, it's plausible that the RBA will maintain a cautious stand, potentially implementing 1 or 2 additional 25 basis point cuts by the end of 2025. This would bring the cash rate to approximately 3.6% by the year's end. However, these projections are subject to change based on evolving economic data, and the RBA will continue to monitor indicators closely to ensure that monetary policy aligns with its objectives of price stability and full employment. Now, I think that's a pretty good answer because I've seen major banks come out and suggest there's anywhere between 2 and 4 rate cuts that are going to happen over the next 12 to 18 months. One thing is for sure, with the latest inflation data coming out, we have seen that things have slowed down when it comes to inflation. Now, if that starts to accelerate back up in terms of inflation, I think it'll be a watch and see approach. I don't think a rate cut of 25 basis points is really going to make too much of a difference when it comes to inflation here. And so what I think is going to happen is over the next 6 months, we're probably going to see inflation continue to drop, although it would be quite gradual. And we probably see 1 rate cut in the next 6 months. And I think it's because they want to see exactly how it plays out. Now, if things move faster in either direction, that is when the RBA will actually go and adapt. Now, I do think that there's going to be 50 basis points more of a cut, and that will bring it closer to where the national average has been over the last 30 years, which is about 3.87%. At the moment, we're at 4.1%. Now, the next question is something that we all get asked every single day, which is it a good time to buy now or wait? Let's see what answer we get here. Whether you should buy now or wait depends on your financial position, investment goals, and market condition. Here's a breakdown to help you decide. So reasons to buy now is the long-term growth potential, rising property prices, lower competition, equity growth, and strong rental demand. Now, a couple of things I will highlight here is the rising property prices. So many Australian markets are still growing despite high interest rates. Delaying might mean paying more later. And I agree with this, especially with what's been happening. We saw a small blip in January and everyone got excited that the market's slowing down. Since then, we've seen the latest data come out from CoreLogic suggesting that prices have gone up by 0.3% in the month of February, which means now we should have confidence come into the market with people that don't believe interest rates will go higher. In fact, the next move is most likely a cut at some point in the next 6 months. So with that, if you delay buying now, you just have to be comfortable paying a lot more. And if you're looking at an area that grows quite quickly, then you're probably losing money every single month. But again, that is the choice that you make. Now, reasons to wait. Interest rate uncertainty. We don't know if interest rates are going to go up or down or stay the same. More affordable opportunities. So some distressed selling could emerge if rates remain high, offering potential bargains. Again, these are probably going to only occur in markets that don't have as much demand. In the markets that are strong, you could put up a listing and you're most likely to get the price you want anyway. And then personal financial readiness. So this again, just comes down to whether you have the deposit, can you make the move, and if you need to move with confidence, do you have the people around you to do that? The verdict is, if you find a good deal in a high growth area that fits your strategy, you should buy now. I'm actually liking ChatGPT. If your borrowing capacity is limited and you're unsure about managing repayments, consider waiting while improving your financial position. So that could be in the form of a high deposit, or you're waiting for interest rates to cut. And from a cash flow perspective, that is more reasonable for you, but you're okay paying an extra 30 to 50K later this year. Now I have two more questions, and this one is about people who want to invest in ETFs versus buying an investment property. And we're going to go ahead with the question here. And it says, I've invested in shares previously, and I want to know what will provide me a better return over the next 20 years. If I invest $100,000 into ETFs, or if I buy an investment property in Queensland for $500,000, can you base this decision on the average growth rates over the past 20 years? Now, before I jump into this, if you are interested in how real estate investing is done well and how you can build a repeatable system for yourself, definitely go check out this video. It's about 36 minutes long. You can check it out after this one, so bookmark it. Investments in ETFs. The Australian stock market has historically delivered substantial returns. According to Vanguard's 2023 index chart, Australian shares have provided an average return of 9.2% over the past 30 years. This suggests the $100,000 investment in diversified shares ETF could grow significantly over the next 2 decades. Cool. Investment in Queensland property. So property values in Queensland have experienced notable growth over the past decade. For instance, the Gold Coast region has seen prices triple over the past 20 years, equating to an average annual capital growth rate of approximately 6.3%. Applying this growth rate, a $500,000 property could appreciate substantially over 20 years. So I haven't really gone into breaking down the numbers unless that comes later, which it does. Comparative analysis. So if you went into ETFs, the initial $100,000 investment growing at 9.2% could potentially reach $583,000 after 20 years. Again, in this situation, you've taken no debt. With the property, you're buying a $500,000 property appreciating at 6.3%, but you have $400,000 worth of debt. So if you paid nothing towards that debt, you would still have that after 20 years. But the property could be worth $1.7 million. Which means even after you take out your costs of actually paying out the debt of $400,000, you're still left with $1.3 million over 20 years. Now, considerations you need to make is leverage, diversification, liquidity, and costs. And again, you can pause the video and look at what those details look like. But the conclusion is that both investment options have the potential to yield substantial returns. With property investments, while offering lower average annual growth, benefit from leveraging larger sums of money. Your choice should align with your financial goals, risk tolerance, and investment preferences. Another thing to note is that there's no guarantee that the ETFs will grow at the rate they have over the past 30 years, over the next 30 years, and the same goes for property as well. But I like where it's headed. It's the same way I would have thought about property as well. And it's a big reason I sold all of my shares when I was getting into property. Now, the final question I have here, and if you like these sort of videos and you want to keep up to date with the market, with statistics and free information, you have to smash that subscribe button. And it means a lot to me because we're trying to get the community to over 100,000 people in 2025. If you can spend literally 2 seconds hitting that subscribe button, it'll mean the world to me. Let's go into our final question, which is, I want to purchase multiple properties and eventually retire from passive income I generate from my real estate portfolio. Can you advise how I can purchase multiple properties? So this is scaling up your portfolio. While this comes up with an answer, you can check out this video, which is how you go from 100K to building a portfolio worth $5 million. And I break down exactly how you do it. Now, one, you want to build a strong financial foundation. So you want to improve your borrowing capacity, which means maintaining a strong credit score, reducing your personal debt, and optimizing your income structure. It could also mean diversifying it and, increasing how much income you make. You want to save for deposits initially, and then you can use equity. You can structure your loans correctly, which is why it goes back to having the right mortgage broker so they can structure your entire portfolio the right way from the beginning. Next up is you need to purchase your first investment property, which makes a lot of sense. And something I like is they mention consider rent vesting. If your local market is expensive, buy an investment property elsewhere while renting where you live. It's exactly what I do, and I've been doing for the last 5 years. Leverage equity to buy more properties. And I'm glad that they give an example here as well, because if someone doesn't watch my videos, well, if they don't watch my videos, they probably don't know how to do this anyway. So it's good that they have the example there because it breaks it down super simply. Actually, one thing I want to make note of here is it says 80% LVR. You can go as high as 90%. You want to scale efficiently. So you want to repeat the process, diversify locations, and use smart financing strategies. These are all of the things that we talk about in our team when it comes to helping people like yourself. So if you're looking at scaling up a portfolio, you're looking at this and saying, okay, how do I repeat the process? Well, if you got into investing by accident, how can you repeat the process? Which is why if you need the help, use the link in the description box below to book in a call with our team. It's completely free. They're going to be able to help guide you and get you set up for what you want to do. You want to focus on passive income and retirement. So you want to target high cash flow properties over time. So again, you get the growth up front, then you go over time and switch out those properties for more cash flow plays. All those properties that you have will now generate you passive income. Depending on how much income you need, you could hold on to those investment properties that give you really good growth. And again, the growth is tax-free. When you retire, you can sell it and you have massive tax advantages as well. And you want to work with a team of experts. Again, we've covered this off, but I think it's very, very useful to use a tool like AI to at least get started. But again, you're going to need the human touch because the Australian market moves so quickly and what you see online is very different to what's happening on the ground floor. So if you need help, reach out. But again, you want to stay on top of the market, then definitely subscribe to this channel because I talk about this stuff every single week. I absolutely love it. And if you're someone who wants to read a book and it's been a big goal for yourself to retire with real estate, definitely go check out my book, Retire Filthy Rich with Real Estate. It's available online. I'll leave a link in the description box below for that as well. If you enjoyed this video, you're probably going to enjoy this one. Go ahead, watch that one, and I'll catch you guys in the next one. Thanks, guys.